A rough week for the banking industry.
The collapse of Silicon Valley Bank.
The second biggest bank collapse in U.S. history.
Meanwhile, Signature Bank marks the third largest bank failure in U.S. history.
We're back with some breaking news this morning. First Republic Bank has been taken over by federal regulators and sold to J.P. Morgan Chase.
The U.S. banking system is sound and resilient.
Welcome to Market Demystifiers. As requested 3 weeks ago by AGNSOS, a video about banks has arrived. Alright, so coming back to the banking system in the US. As you can see on this chart, which is showing you the bank failures over time in the US. The red line shows you the amount of banks which failed in a given year. And as you can see in 2023, only 4 banks failed. So that's good, right? Unfortunately, no. Because what's important here is the size, is how big the banks which collapsed were, how many assets did they have. And if you look at this green line, this is exactly what it's showing to you, how big the banks which collapsed were. And if you look at the 2023 number, which is showing around 550 millions, and compare it with the global financial crisis in 2007-8, we are already significantly above those levels. The problem here is that it doesn't look that like end is anywhere near. And you know why the banks are in this stressed situation? As interest rates are rising, the Fed was hiking the rates very significantly, very quickly. The cost of funding for the banks rises, and it's more difficult for them to make money. Unfortunately, this problem is further aggravated by the lack of demand, by the smaller demand, as not only the cost of funding for the banks has risen significantly, there is also smaller demand. Less consumers want to take loans, less companies want to take loans. There is less activity in the market, less mergers, less acquisitions. So the cost for the bank has risen, but then the revenues has decreased. It's not very difficult to think what would be the implication of it. Smaller profit. Unfortunately, there is another problem. Bank is a normal company. It's also managed by people, and the people make mistakes. In case of banks, there are really a lot of regulations which should ensure that the bank will not fail. But if you look at this chart, what it's showing you is the unrealized losses or gains on investments done by the banks. Now, what are the unrealized gains or losses? So in simple terms, if I open a trade and I start losing money, but I don't close the trade. So I see, let's say I'm losing $1,000, then I'm losing $2,000, but it only will be realized once I will close the trade. And as you can see on this chart, basically banks have made investments which are going south. They are losing a lot of money. But as long as they will not close those investments, it won't be realized, so it won't be on their financial statements. The problem is that sometimes the time comes when you need to close your investments because, for example, your depositors want to take a significant amount of money from your bank. And this was the case of Silicon Valley Bank. And I will go through those statistics through their balance sheet. However, before we go there, I want you to listen to a conversation between the CEO of the Silicon Valley Bank and Senator John Kennedy. Silicon Valley Bank was the second biggest, largest bank failure in the US history.
Now, when interest rates go up, the price of government bonds, especially long-term, long maturity government bonds, goes down, doesn't it?
Yes.
And you don't have to be Einstein's cousin to know that, do you?
No, you don't.
Okay. Now, your bank had 55% of its assets invested in government bonds, didn't it?
Roughly, yes.
And the Federal Reserve raised interest rates, didn't it?
Yes, it did.
And the value of your assets went down dramatically, didn't they?
Yes, it did.
Okay. And you didn't have hedges, did you?
I don't have access to my SVB documents, so
well, I know that, and I wasn't CEO. You weren't hedged. Now, if you'd bought those hedges, that would have cut into your profits, wouldn't it?
Senator, I don't know the details of the decisions that the team were evaluating.
But if you bought a hedge, the hedge costs money, and it would have decreased your profits, wouldn't it? Do hedges cost money?
Yes, they do.
And so if you bought hedges, you'd have less money, right?
Senator, it depends upon, yes, they would cost money, but it depends upon how the hedges
And if
were
you'd
selected.
made less money, that would have affected your bonus, wouldn't it?
Senator, our compensation was predominantly long-term in nature, and so I know there's been lots of discussions about compensation being short-term. From my
Becker, you made a really stupid bet that went bad, didn't you?
Senator,
And the taxpayers of America had to pick up the tab for your stupidity, didn't they?
Senator, there were a series of events, unprecedented events that occurred that led us to where we are today.
No, this wasn't unprecedented. This was bone deep, down to the marrow, stupid. You put all your eggs in one basket. You put all your eggs in one basket. And unless you were living on the International Space Station, you could see that interest rates were rising and you weren't hedged.
Just so you know, a hedge is a protection. So let's say if Silicon Valley Bank bought a lot of US government bonds, and because the interest rates were rising, the value of those bonds was going down. They were losing money. So if they had bought hedges, they would minimize the loss. Alright, so coming back to the balance sheet of SVB. At the bottom you can see the liabilities, which is the funding of the bank, which is mostly deposits. At the top you can see the assets, so ways in which the bank is investing the liabilities so that they can make money. Now what strikes here is that almost 50% of their liabilities are non-interest bearing demand deposits. What it means that people who gave the deposits don't get any interest of them. They are not earning anything. So logically, if you see higher inflation, if the interest rates are rising, you would probably take your money and go somewhere else. The second problem, which also the senator has mentioned, is that they have put all their eggs in one basket. And what he meant by this is that they bought so many US government bonds and they were not hedging, which as a result, when the US government bonds, the value of them was going down, they were losing money. And it was creating a double problem, with depositors wanting to leave and SVB not being able to give the deposits back. What they needed to do is close some of their positions, but closing them meant closing them on a significant loss, which, as you might think, didn't help to build the confidence of their depositors. Unfortunately, there are still some dark clouds hanging on the banking sector in the US. As reported in the Senior Loan Officer Opinion Survey, which was released on Monday, logically, the credit conditions are still very tight because the Fed fund rate, so the interest rate, is still extremely high as compared to previous years. And the demand for consumer loans, for companies' loans, is also decreasing. It's getting close to the levels seen in 2009 and 2001. In both occasions, we had massive recessions. And it's not only the regional banks having problems, the big banks also have them. Look here, Goldman Sachs, year over year, net income down almost 60%. The next slide, Morgan Stanley, year over year, down, net income down 12%. Again, big decrease. Citigroup, year over year, net income down 36%. The one bank which is holding quite strongly is JP Morgan, having the net income up on a year-over-year basis by 67%. Alright, that's all what I wanted to cover. Please like and subscribe if you enjoyed the show, leave a comment, and see you in the next one. Bye!